Hello and welcome to India Explained, the place where we make money simple. Today, we are getting into a huge one, a real classic. But hey, before we start, if you find this explainer helpful, do us a quick favor and hit like, share, and subscribe. It really helps us out a ton. Yaar, you won't believe it. This is the exact same argument my parents and I were having just last week. They're convinced gold is the only safe way to go, but all my friends are jumping into the stock market. I mean, seriously, what's the right answer here? Okay, let's settle this debate once and for all. It's a classic for a good reason. Instead of just going back and forth, let's just look at the hard numbers. And to kick things off, let's see how they've both done recently. And, well, you might be a little surprised to hear. Gold has been on an absolute tear. Check this out. If you had started a simple monthly investment, an SIP, in a gold ETF, which is basically a fund that just tracks the price of gold, your return in just the last year would have been a massive 54.35%. Whoa, hang on a second. Over 54% for gold, but the Nifty 50 is barely at 3%? That is a gigantic difference. Oh, my parents are going to absolutely love seeing this slide.
Exactly. And this shows you gold's special role perfectly. It's what we call a safe haven asset. So whenever there's economic stress, some global uncertainty, or high inflation, investors tend to flock to gold for safety. And that demand, well, it just pushes the price up. The past year had all of that in spades.
But, and this is a big but, 1 year is really just a snapshot in time. Investing is a marathon, not a sprint. So for round 2, let's pull the camera back and look at the bigger picture. And here you'll see the story completely flips on its head. Let's say you invested 5 lakh rupees 5 years ago. In gold, that would be worth around 9.5 lakhs today. Pretty good, right? Solid return. But that same 5 lakhs in the Nifty 50, it would have grown to almost 11.8 lakhs. That's more than 2 lakh rupees extra in your pocket. And if we zoom out even further, say over 2 decades, the trend becomes crystal clear. The Nifty 50, which is basically a basket of India's top companies, has consistently delivered really powerful returns. And that's because when you invest in the Nifty, you're not just buying stocks. You're betting on India's growth story itself. It's the real engine for long-term wealth creation. Okay, I think I'm getting it. So in the short term, gold can be the winner if things are rocky. But over the long term, the Nifty 50 pulls ahead. But why? Why do they behave so differently? What's going on under the hood? That is the perfect question. The easiest way to think about it is that they follow completely different playbooks. Gold is kind of like your foul-weather friend, or, an emotional support asset. It doesn't actually produce anything, but its value skyrockets when people are feeling scared about the economy. The Nifty 50, on the other hand, is directly plugged into the health of our country's economy. When Indian companies are doing well, making profits, and growing, the index goes up. It's a pure growth engine. Right, got it. So gold is like your defense, and the Nifty is your offense. That actually makes a lot of sense. So let's get back to my big problem. What should I be doing with my savings? Which team am I supposed to pick here? Well, here's the best part. You don't have to pick a team. That's not the goal at all. The smart move isn't trying to guess which one will be the winner each year. It's about building a solid strategy that uses the strengths of both. So this brings us to the most important concept, portfolio allocation. Most financial experts will tell you that for long-term investors, the bulk of your money should be in growth assets like equities. But, and this is the key, allocating a small chunk, maybe 5 to 15%, to gold acts as a stabilizer. It's kind of like a shock absorber for your portfolio, protecting you during those really rough patches in the market. So let's circle all the way back to that great Indian investment debate we kicked off with. Is it gold or is it stocks? So the answer is both. You use gold for that stability as a kind of insurance policy, and you use the Nifty 50 as your main engine for that long-term growth. So my parents and I were both a little bit right.
You nailed it. It's not a competition. It's about building a smart, balanced portfolio that's going to work for you through the good times and the bad.
And we really hope that clears things up. Remember, the goal isn't about picking a winner. It's about building a winning team that helps you reach your financial goals. If you enjoyed this explainer, make sure you're subscribed to India Explained for more.
Yeah, and definitely let us know in the comments what big money debate you're having at home. Who knows, we might tackle it in our next explainer. Thanks for watching.